All right, welcome back, everybody. Good to see you again. I hope you enjoyed your Easter break. For any of you that were up in New York, I hope you survived the snow up there as well. And ready to get going. We really have a very limited amount of time left. Our plan today is we're going to do the review.
Which class is it?
IS 353.
Turn off your mic. We're going to do the review of the week, and then we're going to cover Chapter 11 for sure. We'll get through that without much trouble. Talk a little bit about the weighted average cost of capital assignment, and then we might talk a little bit about Chapter 13, depending on how far we get. But for now, Christian and Connor, we're ready to hear about the week. Go ahead.
All right, so we got the review of the week this week. All right, we're going to start by talking about the Dow Jones, which was up 389 points as of the close of yesterday, about 1.65%. Only notable loser there was General Electric. This was in part due to the tech rebounds from Monday's big losses. A little more tied to the NASDAQ, but obviously the Dow measures it as well. And this volatility has just been crazy. It seems like every day we're up and down 1.5%. So this leads us into our first question for you guys. Do you expect it to continue? And if so, for how long? I glanced at it today. It looks like we were down another 1.5%, reversing yesterday's gains. So what do you guys think? How do we call on people, Professor?
Okay, just call their name and ask them what they think.
I can't see everyone.
Who's in class?
How do
You got to hit the down arrow there.
Yeah, if you hit the down arrow, you can see who's on. And you guys, you can raise your hand if you want. Use the raise your hand button because they may not see you.
Money?
Yeah, Ryan Money, what do you think?
Money.
What do I expect? I'd say, yeah, there's going to be a current trend of volatility just because a lot of uncertainty with investors and stuff like that. And it was such like a going up for so long. And then people didn't really know what was going to happen now since it's kind of been up and down. I just think it's going to continue like that for a little while longer. Not really sure how long.
Okay. Anyone else? Tyler, any opinions on the volatility? She's eating.
I just think that it's going to continue to fluctuate. Right now, I feel like there's a lot going on regulation-wise in the tech industry, and then also with all the tariffs that are being issued both by Trump and this morning by China. So I think that right now we're just going to see a lot of up and down, but I think it'll stable out in a couple weeks maybe, or a week or two.
Okay. Sounds good.
Yeah, I guess we kind of expect the same thing. I mean, there's no reason to believe it's going to stop.
Yeah.
It's just kind of crazy, unpredictable. I don't necessarily know the root causes or what's going to stabilize it, but yeah. All right.
So next one is Standard & Poor's, kind of along the same lines as the Dow. It went up 32 points, but that's 1.26%. And that was just consistent with the volatility that's been going on this week. So not much really there to talk about.
The NASDAQ. So this one's a little more interesting because it's more closely tied to the tech companies. Those FANG companies we were talking about last week, they all showed recoveries from Monday's losses. Tesla is something we seem to talk about every time, so I thought it was worth mentioning. They did not hit their production goals, but they came close enough that the market was pretty optimistic. I think it was like 2,000 something out of the 2,500 goal. So they actually experienced some gains as a result of just coming close. But overall, they're up 71 points to the NASDAQ, about 1%. Yeah, like I said, the tech companies just rebound. Big tie to that performance.
Alrighty. So now getting into some more particular news on a per company basis. Amazon, as of yesterday, had lost a substantial market cap of about $60 billion, and of that, nearly 10 of it was Jeff Bezos' personal losses and his own net worth. And this comes out of the new feud with President Trump against the e-commerce giant, particularly relating to their deal with the United Postal Service. So the deal pretty much establishes so that Amazon can utilize the United Postal Service to deliver packages in areas where it's not profitable enough for Amazon to deliver themselves. And on average, the average package loses the United Postal Service in losses $1.50. So I don't know how closely any of you have been following this, but the question we have is, should the United Postal Service continue making deals with private firms that are turning a profit at the taxpayer's expense? Another example was FedEx that has a very similar deal. So just any opinions there? Oh, Tyler?
Oh, okay. Yeah, Tyler, go ahead.
Yeah, Tyler, go ahead.
So something that I read about this was that the United Postal Service isn't technically losing $1.50 on packages. It's just that they could stand to charge $1.50 extra on each one delivered. Their merger with Amazon is profitable for them. So the reason that they're not charging more is because they don't want to lose Amazon. They get a lot of their revenue stream from them. So I think that the United Postal Service should continue to make these deals with private firms, because ultimately they are going to make money off of it, even if they're not charging as much as they really could be.
Any other opinions?
Pick on somebody else, I guess.
Chaz, what do you think?
Yeah.
Chaz?
Chaz, turn on your mic.
You hear me?
Yep.
Possibly, I would say so. I mean, mainly I would say for the Postal Service, I would say kind of like they don't necessarily, like what Tyler was saying, for them not wanting to lose business with Amazon, because they already have UPS and FedEx. So I mean, I don't necessarily think that would be a big thing, but I don't know. Not really sure about that.
Our next news of the week was the EPA. Scott
Hold
Pruitt.
on a second, Christian. I think this is important because Tyler brought up a really good point. This is sort of the whole fake news debate. The fact that the Postal Service charges Amazon $1.50 less than if it were being shipped, and hey, Chaz, turn off your mic, please. Charges them $1.50 less than they would have charged if they were doing it on their own. Technically, they lose $1.50 in margins, but they're making money, and they have volume again, and they're sustainable. So this is one of those cases where you have to dig into the news a little bit more to understand what the story is telling you. The USPS is actually making money on this deal. So the framing of the issue, I think, came into play here. That was very negative for Amazon. They definitely suffered some losses because people didn't take the time to do what Tyler did and read the story a little bit thoroughly to understand what really was going on.
I thought the debate was around the fact that the USPS was like a quasi-governmental entity. Is that right?
Yeah, it is a government entity.
No, I think people just feel wrong with the fact that they're cutting Amazon. It just rubs people the wrong way, whether or not it should.
It's the same about tax incentives to get a headquarters in town. Is that the right thing to do? Well, there's trade-offs. Do you want the business or do you want to go out of business? And so there are costs, and people react when it's government, but government agencies cut a lot of deals. I had one other question before we go on. Are you going to say anything else about Tesla? Yeah. Okay, good. I didn't look at all your presentation. I wasn't sure. Okay, go ahead.
Okay.
Yeah, I think that's our last news.
So Scott Pruitt, the head of the EPA, announced he would be easing the Obama-era fuel emission standards. So in 2011, the Obama administration announced that car manufacturers would need to hit an average mile per gallon for cars and light trucks of 54.5 by 2025. It's alleged that it would cut over 6 billion metric tons of greenhouse gas. Pruitt was not specific on whether or not he'd be revoking it entirely or just reducing the requirement. But yeah, he just announced his intention, and this guy's come under some fire. I think he's announced head of the EPA, but he himself has sued the EPA several times. So yeah, it's kind of a trade-off. Like, obviously, this is going to help car manufacturers. They'll be able to produce cheaper. I read that there was some safety concessions with meeting these fuel emission standards. They have to make these cars lighter and less able to withhold a car crash, and it's a big two-sided debate. So we really wanted to get you guys' opinion on it. So will the easing of the standards help the auto industry? And what do you think about the trade-off between economic prosperity and environmental protection? Any opinions on this? Okay. Somebody new. Bridget, what do you think?
Personally, I think that it's not worth the trade-off for environmental protection. I'm sure it'll help the auto industry, like financially, but I don't know if it's worth it in the long run.
Okay. Anyone else?
Tyler had her hand up. Let's see what Tyler has to say.
Tyler?
Okay.
I feel
I
like
didn't
I'm like
think so.
dominating this
That's okay.
the comments lately, but I also think that I agree with Bridget totally. I don't think it's worth the trade-off. I think environmental protection is really worth it. I don't think that the standards should be eased back. It will help the auto industry, but ultimately the auto industry is changing anyway. So, I mean, it's kind of on the wrong side of history to believe that, we're gonna, like, you need to move towards electric or hybrid vehicles to be on the correct side of industry, like, and be profitable ultimately in the future. So even though these standards are being eased back to help some of the, maybe like the truck dealerships and kind of things like that, I think that ultimately it won't matter anyway if he eases back on the standards. I think each car company is moving towards an electric or a hybrid vehicle. So.
Okay. Yeah, I think I would kind of take the other stance on this one. A lot of electricity is generated by fossil fuels anyhow, so these cars aren't being powered by total clean energy. And from what I read, this 2025 54.5 miles per gallon is really, really ambitious. I don't know about you guys, but my car gets nowhere near that. And yeah, I think this is just going to cost the manufacturers a ton. It's going to cut variety in the cars that they can make. You're going to lose affordability. That's just going to hurt sacrifice safety. I think it's going to hurt the industry in general and be a net loss for them. All right, next.
Hold on a second. I want to talk about this a little bit. When I was in high school was when there was huge gas shortages, and so at that point in time, they looked at your license plate, and if it ended in an odd number, you went to get gas on Monday, Wednesday, Friday. Otherwise, you go Tuesday, Thursday, Saturday, and huge shortages. And it shifted people's belief about cars, and so they stopped getting such big cars, and cars got smaller, and the manufacturers made them more fuel efficient. The crisis passed. What's happened now is we're back to lots of big trucks and big SUVs. Do you think any of these standards, do you think that we should be continuing to manufacture and promote the larger vehicles, or is this a point in time when so is it free choice, or is it more important to think about the environment and energy standards? What do you think?
I think for this one, it's important to note that this standard only applied to cars and light trucks. So I would think that your heavy SUVs and big trucks are omitted from that standard. I didn't read anything as to what that standard would be or is currently. But yeah, that's another tough question. It's like a trade-off. I don't know.
Well, I personally I have a truck, and I'll always have a truck my entire life. And the trucks have gotten phenomenally better with gas mileage in the past 10 years. And I think they'll continue to, because that's just another perk for buying the vehicle. But I think that arbitrarily producing such an ambitious goal for these light trucks and cars while sacrificing safety just isn't worth it, especially when America, I mean, we have a huge carbon footprint compared to the rest of the world, but China and Russia and many other countries are not doing the same that we are. So, and we all live on the same earth. So I don't think that it's worth sacrificing in our country the economic prosperity for the environmental protection when the rest of the world isn't on board. If the rest of the world could get on board, then yes, I would be much more apt to taking this side. But when it's just us, I don't see the worth in it.
Yeah, one more thing on this, and if it is truly the consumer's belief that we should be cutting down and shying away from these SUVs, then these SUVs wouldn't be the most popular cars sold in the country right now. I think the free market would ultimately regulate that. If people wanted more fuel efficiency, then that's what's going to sell, and that's what's going to be profitable for the firms to produce. So I think government regulation in this case is just not helping.
Well articulated arguments. Whether or not we agree with you, I think your arguments were based on good fact. That's good. Thanks.
Okay, so yesterday, Spotify went public with a very unique IPO as a direct listing, and that's where they had no investment bankers backing any of the sale of their stock. The initial valuation, which was an ambitious one, or at least I thought yesterday, was $132 per share, which put the company at $23 billion. Reuters had only valued them at 19, and this is amid 2017. They had $5 billion in revenue, and they've had consistent growth over every year at about 40%, which is phenomenal. But they still posted a $1.5 billion loss for the year. The company's also never turned a profit. But on opening day yesterday, the stock closed at about $165, $166 per share. And our question was, if anybody's been following it, would you purchase Spotify stock? And do you think that maybe the market was a little too excited about Spotify? Is there still more room for it to grow? Anybody?
Yeah,
Angie.
Well, personally, like saw. Okay, let me just. Do you guys want to mute? Okay, sorry. I saw this. It's still bad.
Someone else not me.
Sorry. Okay, sorry. I don't know. No, it's not connected.
Yeah, guest speaker.
Hi guys. Okay, so personally, I saw this yesterday. I was kind of surprised. I really thought they were already public. So for me, I was like, oh, okay, this is cool. I saw it, like a notification pop up on my phone, and I would purchase it. But there's also like the whole thing where everybody got super excited about like Snapchat, but then like the dip or whatever. So this could go two ways. It could keep growing, or the next big thing could come out after Spotify and also take over. But as of right now, it looks like a good stock to purchase.
All right, thanks, Andy. Anyone else have an opinion on this?
Anything else?
All right.
This was an interesting one because this was not an underwritten offering, and so it could have gone anywhere. It was highly volatile, but it did end up for the day. Spotify and their CEO walks a really interesting line because they have to support the big three record producers, and yet they're really trying to undo their industry. And if you listen to the CEO prior to the offering yesterday, he is trying to dial back some of the rhetoric he had going into this, where he alienated a lot of people. We are going to be the next music industry, and they're going to get rid of all the others. It's just going to be the likes of Spotify. So he has tried to modify some of his rhetoric recently, and it looks like it worked. This was a gutsy offering that they did, and it's been successful. So it was a fun one to watch yesterday.
All right. So to what I assume you were mentioning, Professor, the Uber and Tesla deaths. So Uber's autonomous vehicle in Arizona struck and killed a pedestrian, and Tesla had a sort of similar incident where their autonomous SUV collided with a highway barrier, killing the driver. So in both cases, there was a human at the wheel, so it was this weird middle ground of autonomy and manual. And so I found this quote that was from Brian Smith, who's a professor at USC. It is dangerous when people feel safer than they actually are. So these people are lulled into a false sense of security. I guess they didn't, I'm not really too sure on the specifics, but I guess they didn't react in time to prevent these casualties. And it really brings about a debate. Is it ethical for these people to be testing these cars in not controlled environments? And I realize it's necessary to complete development, but yeah, we just wanted to spur a debate on this one. Should the development of autonomous cars stop? If not, how do they continue? Obviously, their stock suffered as a result, but have since had some recovery. Any opinions on this? Okay, just calling. Alexa. All right. Yeah, Alexa's gonna come over and speak again.
So I'm not a fan of the autonomous driving. It actually really like irks me. So my dad just got a new Acura, and it has this feature where if you're on the highway and it can sense the lanes, a little steering wheel pops up and it's keeping you in the lane. So he's like, oh man, I don't have to drive with hands. And it's like, for me, it's like such a recipe for disaster. Like, what if you hit a pothole and you're like, oh wow, I'm in another car. So I personally don't like it. I think people, if they're paying attention, are a much better source of control than like a self-driving car ever could be, especially given the recent deaths. So.
All right.
Absolutely.
Sorry. I just also think that, I know maybe this is like a conspiracy theory, but what if like the car gets hacked, like assassination attempt or something? That's like the perfect way to do it. And I don't know, I just don't think that driving should be some sort of video game. Like, this is a life thing. We're so concerned with like drunk driving, but yeah, like if we're gonna start doing it like this, it just becomes a video game.
Dan, you wanted to say something?
Yeah, I completely agree with what Alexis said. It definitely should be more testing. It's definitely going to be hard to make a fully autonomous car with drunk drivers, people who are under the influence, people who don't know how to drive, and uneven roads and stuff like that. So I don't think it should stop. I should just think there should be a lot more testing in situations like that.
I think that
We got another one.
I think just like any new technology, there's going to be an introduction phase and there's going to be things that need to be fixed. I think that it's just because this is a new technology that's like groundbreaking and it's out of a human's control as to what happens is the reason why it's in the news so much. Because there's only been 2 instances so far, so compared to your normal car deaths, I mean, it's minuscule. It's just the fact that it's this brand new technology that's out of a human's control that I think it's gaining so much news. But I think that this is the testing phase, and so far in the testing, it's gone well for the most part with the with everything besides these 2 instances. And I think things like this will be changed over time, and it's just an implementation phase. And I think, just like I said earlier, I think that the reason it's gotten so much news is just because of how new the technology is and how we don't have control over it.
Yeah. I would say we relatively agree as well. Just like anything, when the new technology comes out, you probably don't want to be the first or second person in line to get that brand new surgery while they're still trying to work out the kinks. Maybe you want to wait 10 years down the line when they mastered it a little bit better, but it is something to keep an eye on. Hopefully they can start righting the problem sooner rather than later so that less people have to suffer as a result.
Yeah, another thing to be interesting is what kind of volume they're testing these things at. Is it, did 2 of 2 tested cars go wrong, or was it 2 of 500? Yeah, I think it's going to be tough for Uber and Tesla to really answer for these deaths, but yeah, it is a sad reality of developing this new technology. But yeah, I definitely think it's unethical for them to be testing because clearly the technology is not totally there.
In the case in Arizona, do you think it was the technology that failed or the human who was looking down when the woman walked? It looked, I hate to blame somebody who's dead, but it looked like she stepped right in front of the car, with her bike.
Yeah, this is a tough one. So should the driver have been complacent? I don't know.
Yeah.
That's really tough.
I don't know.
Also, never mind. I guess the car wouldn't have time to react, but
the guy was a felon, and so who are they putting there as the test drivers? How many of you fly? And how often do planes go on autopilot? The pilot's sitting there, but the plane's flying itself, So trains, they have the same kind of technology. Everything that I've read about this technology will decrease traffic accidents. It will decrease slowdowns of traffic because it will be moderated and such. They're building all of the Lexus lanes anyway now, and so those can easily convert into driverless lanes to sort of do the next stage of testing. And with all new technology, we go through a period, and they did all of the testing with driving round and round and round the tracks.
Right.
And so they have to simulate real world situations. It's a learned technology. It has to learn how to react in different situations. And so if we want to pursue this kind of technology, which they believe will ultimately save lives, not every life, some people will die, but less than die in accidents now. We have to test it, and there will be setbacks. And I, for one, am a huge Uber user, and I love when somebody's driving me and I don't have to. I can get 6 other things done and not feel guilty if I'm on my phone while I'm sitting in the back of a car as opposed to when I'm driving. So, yeah, I hope it. I know it will continue. I hope we get to where these work in the not too distant future, because man, I will. Sorry, Connor, I'll be one of the first ones to get tested and buy one of these cars.
The one that has a good testing experience.
Yeah. Hopefully it'll end well. The other thing I wanted to talk about with Tesla is, did you see Musk's comments this week?
I don't. Are you referring to his April Fool's joke? All that,
yeah,
which I thought was really stupid. I know it was obviously a joke, but why even bother?
Extremely
You're playing with people's,
Tell everybody, because some people may not have heard it.
You want to read
so
it
he, I don't have the tweet on me, but he basically tweeted using like hyperbolic language. So it was, if you had half your wits about you, you knew it was a joke. But he tweeted that like Tesla's going bankrupt after like they tried to sell Easter eggs or something really stupid. But I don't even know why you would spook the market like that. I think he's a little pompous. That was dumb.
It was stupid, and it gets to investor communication with the markets. The way it was re-reported wasn't that it was an April Fool's joke. It was he was joking about Tesla going bankrupt and missing some production targets. Well, we know they're missing production targets. So the way it was reformatted and sent out was not that it was an April Fool's joke, that he was sort of joking about bankruptcy, and the market reacted. I think they lost over 7% very quickly. So there's a way that you communicate with the market, and he fails so frequently in what he does. But I'm sure they'll bounce back. But although I think they're announcing earnings this week, and production numbers are not looking good, so they may have another bit of a downturn.
Yeah, it just seems like there's a million reasons not to like this guy. I don't know. But yeah, that's my feelings on it. And I think we just have a look into the future.
Look into the future. So there was a caravan headed up here, and that kind of spurred the initial immigration push from Trump on the southern border, and also possibly militarizing our southern border. So maybe we could keep eyes up and open on that. With a lot of the hacks that have been going on recently in the private industry, I think that we could look at increased spending and innovation in cybersecurity for a lot of these firms, because that just simply can't continue forward if you want to do business with them. I was reading a couple articles on new military technologies and weaponry, particularly a new drone that's going to be equipped with heat-seeking missiles and the ability to take off and land in the most remote, harsh areas to back up our troops. Increased tensions with Russia as they kick out, I guess, how many more of our, I can't remember who they kicked out, but they kicked out more American diplomats or government workers there. There was, I think it was Morgan Stanley or Goldman Sachs, one of the two, said that Microsoft could be worth over $1 trillion within the next 12 months. So that would be tremendous growth for them. And in March, we saw car and truck sales up 6.3%, and could this trend continue going forward? So those are just some looks into our near future.
And that's all we got.
Good. Earnings season starts this next week. I think the banks announce first, and then followed by some of the other companies. Earnings are supposed to be great. So when we talk about volatility in the market, I looked earlier, the market was down 500 points. So it's, I think it was back to 350 the last time I looked, but it's still down a good bit. Expect some more volatility. Some positive results though. The expectation is the markets are going to exceed last year's earnings by about 17%. So that's, and they're only expected to exceed by 5%. So that's going to be pretty impressive when that occurs. The other pieces, pop back a slide because your slides had two things on it. Okay, good. Immigration issue, militarizing the southern border is not currently legal without Congress's approval. So we'll pay attention to that and see how that all comes into play. And the other thing that I think is worth watching, you probably saw Lord & Taylor, and I think it's Saks, were hacked this week. They were hacked and their cards used the chip. So now there's a whole lot of question about whether or not this chip technology is even worth it and whether or not there's something bigger and better. And I think, Connor, your point's a really good one. The whole cybersecurity and innovation in that area and companies that can do that well are the ones to watch in the future. It's a risky gamble because you do it well, they're going to do really, really well. If your product fails, it's going to be a devastating failure for whatever company. So we'll pay attention to those in the next couple of weeks. But who are you guys doing a review of the week again next week?
Yeah, we have again.
That's so I think you're going to have some banks announce between now and then. So we'll see. But
okay, great.
Good. Anybody have anything else they noticed from the markets? No? Okay. Nice job, guys. Okay, so now we are going to talk about Chapter 11. Chapter 11 is one of those chapters where we're not going to do a single problem. There's going to be a whole lot of listening, and I'm going to do my best to make it as interactive as we can as we go along. This is the Nobel Prize winning theory of how stock returns work. And to get there, we've got to kind of build the theory. So when we talk about a stock and what we and why we buy a stock for a couple of reasons. We look at what we expect to earn if we own that stock. We look at how risky the stock is, and we look at how it impacts other items that are in our portfolio. So when we start, let's see, how many of you would, and usually the hand raising functions, how many of you would buy Amazon if you could own a share of stock of Amazon? Would you be interested in buying it? All right, Connor, why not?
I personally think that Amazon is just about topped out right now in stock price, and it wouldn't be a good time to buy currently. I'm opposed to buying the largest existing e-commerce already. I can't give you good reasons, but
okay.
I just
not your company. Okay, all right. No, those are both valid reasons, that they're up near their peak and you don't see enough upside, and they're already so big.
Well, especially currently with the fight with President Trump. Anytime, yeah, that's just probably not a good look for PR. But they have bumped back since yesterday, since yesterday they bumped up today. I think like 1.5%. They're back up or something when we checked.
They were down last I looked, but that was they were down about 1.2%. I think last I looked. But Dan, while Connor's looking that up, Dan, what would you? How much are they down?
Just 0.5%.
0.5%. Okay, Dan, what about you, Dan Ryan?
I would buy it.
Why?
Well, because I'm a believer in the fact that I think Amazon's gonna take over a lot of industries. It's already incorporated itself into a lot of industries, and it's got such a wide customer base as is. Every industry they enter, they're already reaching out to such a broad population of people. Just like Chaz was talking about with Twitch last week or 2 weeks ago, incorporating that in the Prime, you already have so many Prime subscribers. So the moment it gets instituted, you've already put it out to a vast population. Same with Whole Foods, their healthcare stuff. I just think that it would take either some big company to come out of the blue and kind of really be able to rival them, because at the moment I don't think they have a huge rival. Or I think their biggest threat is the government breaking them up for becoming too much of a monopoly. So that would be the only reason I'd be a little bit worrisome about the stock. But I think that's at least a few years in the future if that kind of thing were to happen. But I see that as the biggest threat right now, is just a government breakup.
Good. Okay. You and Connor you presented exactly what I was hoping. Okay. So Dan believes that Amazon's going to do well in the future. He believes the expected return is going to be more than what he's going to pay for it. Connor, on the other hand, doesn't think they're going to do so well. He's not interested in owning Amazon, and he believes that they may decline in value. Well, the risk is that there is some return that they're going to earn, and the risk is we don't really know exactly where it is. Now, this theory that we're going to talk about today presumes that everybody has the same expectations. We just saw this isn't true. But this is the way we develop theory. We start with simplified assumptions and then we build on it. So no, as we're going through, you're kind of going, well, that doesn't really make sense. Yell out when it's one of those that doesn't make sense is in your mind, because I can explain it, but it's theory development. All right, so we're going to start right now where we have two possibilities. We can either own a mutual fund full of stocks, or we can own one full of bonds. And what we believe, if we look out a year, we're buying this fund and we're going to hold it for a year. We think we don't know what the economy is going to look like next year. Could just continue as it is. Could be a recession, or we could have a booming economy. And as far as we know, it's equally likely for all those three options. So it's a third of a chance we're in a recession next year, third of a chance it's normal, and third of a chance there's boom. I think if we surveyed, we would probably get about there. I don't think really people have a good sense for what's going to happen next year as interest rates move, and as we're talking about tariffs and trade wars and things, and potentially real wars as well. So if we have a recession, we expect the stock fund is going to lose 7%. If the economy is normal, we think it'll make about a 12% return. And if we have a booming economy, this particular fund is going to make 28%. And we're all pretty much in agreement that's what's going to happen. For the bond fund, if it's a recession, the bond's going to make 17%. And if you think about it, with bonds, when stocks do poorly, bonds typically do well. So in normal times, it'll earn less than the stock fund, about 7%. But in booming times, it's going to lose 3%. That's our expectation. So what are you going to do? Well, what we need to figure out is overall, I know what I expect to earn in each of these three situations, but in general, what's my expected return? And so what we figure out is, hold on, let me do a little drawing here. What we see is that we have a third chance of losing 7%. We have a third chance of making 12%, and a 33% chance that we make 28%. And when we do that overall, regardless of what happens next year, if we own the stock fund, we expect to make 11%. We can do the same thing with the bond fund. A third of a chance that we make 17%, and a third of a chance that we make 7%, and a third of the chance that we lose 3%. And overall, that means for the bond fund next year, overall, we're expected to make 7%. Okay, raise your hand if you would like to own the stock fund next year, and use the buttons, please. Raise your hand if you want to own the stock fund. Nobody? Hold on, maybe I'm just not seeing them. Where's my? Okay. Why am I not seeing it? Okay, Dan, I see your hand up. Are you the only hand up? Anybody else? Oh, I can't see everybody. Connor, can you see where you can raise your hand on the chat button function? If you go into participants, you should be able to see the hand raising button. Turn your mic on, Connor, so I can see. Okay, Christian, I got you now. The rest of you guys are just ignoring me. Okay, or maybe you want the bond fund. All right, Dan and Christian, put your hands down. All right, raise your hand if you'd rather own the bond fund. I'm about to give up on y'all. Okay, so we have some people that would rather own the stock fund earning 11%, and some people would rather own the bond fund earning 7%. Well, let's see. Let's see which one makes sense. Okay, so after we look at the expected return, that tells us something about the fund, but we need to know more. So we want to the expected return is what we hope to make, but there's riskiness. There's no guarantee we're going to make that amount. So we want to look at the riskiness. The way we measure riskiness is with the standard deviation. To get to a standard deviation, hopefully you remember this. There's some of this in Chapter 10 if you need a bit of a review. So you look at the difference between our expected return of 11% and a loss of 7% and square that. Same thing with the 12% and 28%. You add all those together to get a variance, and then add all those together and divide it by 3 because it's a 3% chance to get your variance. And then you take the square root of that to get to, you take the square root of the variance to get our standard deviation. And what we have here is now a measure of risk and a measure of return. So for the stock fund, we expect to earn 11% with a 14.3% standard deviation. The bond fund, we expect to earn 7% with an 8.2% standard deviation. So what we see is the stocks have a higher expected return, but a higher risk. It's more volatile. Stocks move more than bonds. Nothing unexpected at this point. Okay. Okay. Oh, Jesus, things didn't disappear. Hold on. Sorry, let me close this off. Okay. So the other measure we need to look at is the covariance. And the covariance tells us how an item moves relative to another, how they co-vary. And in this case, the covariance between the stock and the bond fund is really very low. Anything close to 0 is quite low. So that would mean if we held a portfolio that held both of those items, we would reduce some of our risk. I pulled this back from Chapter 10, and this is a model that has an expected return of 12% and a standard deviation of 20.1%. I wanted you to remind you what the standard deviation means. So if I expect to earn 12% and I have a standard deviation of 20%, it means that I have a 2/3 chance that my return is going to fall somewhere between 20% on the downside and 20% on the upside. So in this case, I have a 2/3 chance that my return falls between a -8% and a +32%. 95% of the return time, they fall between 2 standard deviations. So between a -28 and a 52, and then 99% of the chance that it falls between a -48 and a +72. Well, those are some pretty big ranges with a standard deviation of 20%, but it gives you an idea of what to expect in terms of the return and the riskiness. You like high returns, but typically the higher the return, the higher the standard deviation. The higher standard deviation is more risk. You're going to buy an asset that has 2/3 of the time the return is going to fall between a -8% and a 32%. That's a pretty sizable range. It's a pretty high standard deviation. So as I said before, the stocks have the higher return than the bonds, but they also have higher risk. Now, we typically don't own only stocks or only bonds. What if we invest in a portfolio that's half stocks and half bonds? And when we do that, what we end up with is in the recession, the stocks are going to lose 7%, and the bonds are going to make 17%. So if we have 50% of our money in each of those two assets, then on average in a recession, we're going to make 5%. We go down through and we do that for each situation. What we discover that if we own a portfolio of the two assets, 50% of our money in each of the assets, our portfolio expected return is 9%, and the standard deviation is 3%. So now what's happened? By combining these two assets together, we earn a return that's higher than the bond fund, and the risk is a whole lot less. So if you had your choice now between owning the stock fund with an 11% expected return and a 14.3% standard deviation, the bond fund with a 7% return and 8.16% standard deviation, and the portfolio, 50% in each of them with a 9% return and a 3% standard deviation, I now want to find out who wants to own which one. Okay, raise your hand if your preference is to own the portfolio that has a 9% return with a 3% standard deviation. Raise your hand if that's what you want. Okay. Let me pop through so I can see everybody's hands because you guys are raising them virtually. Keep your hands up so I can see them. Okay. A good number, you want that one. Raise your hand if you would prefer. Bridget and Dean, turn on your videos for a second so I can see you guys. Raise your hand if, or raise your hand buttons. Raise your hand if your preference is to own the bond fund. Now keep your hands up because I got to flip through everybody. Okay, and raise your hand if you'd rather own just the stock fund. Okay, okay. The decision to own just the bond fund really doesn't make sense, because if you just own the bond fund, you're making a 7% return with an 8% standard deviation. Why would you do that when you could earn a higher return by combining it with stocks, the higher return being 9%, and reduce your standard deviation to 3%? That one doesn't make sense to own the bond fund on its own. However, to own the stock fund on its own, that might make sense if you're okay with risk and you want the likelihood of a higher return, especially as you're younger. When you're younger, you typically like high returns and you're willing to take on some additional risk. The reason that we had the great reduction in risk is because, as we saw earlier with the covariance between the two is very low, and we can see it right here. Recession, the stock's down, the bond's up. Normal, the stock fund does better, but when we're booming, the bond fund doesn't do well. So they vary in the opposite direction. It's really hard to find stocks that vary perfectly in opposite direction perfectly. That's hard to come by, but it's not hard to come by stocks that have some level of covariance that creates some value in creating a diversified portfolio. Okay, I said that already. Now, here we said, well, when we did the first example, we said we have 50% of our money in stock and 50% in bonds. We don't have to do 50%. We could have different percentages. And what we see here is that there are some situations like, let me see. Oh, okay, here. Like this portfolio. Nobody would ever want to have 10% of their money in stocks and 90% of their money in bonds, because look, if you did 50-50, you'd have a higher return at a lower risk. So this 10% portfolio is not a good portfolio. Nobody should want that, because you'd have lesser return with higher risk. Same with all of these. They have more risk and not as high return. So none of these portfolios are as good as the 50-50. So we can eliminate those as possibilities. There are other portfolios in this range that don't have as high return, but they have lower risk. So some people might choose those portfolios because they don't like risk and they're willing to take a little less return. Other times, and a lot of you guys should fall into this situation, you're willing to go here. You get higher returns than you do at the 50-50 portfolio, and you get more risk, but you're willing to take on more risk. And in fact, if we plotted all of these different combinations of stocks and bonds, we come up with a graph that looks like this. And what we know is that the items that fall down here, nobody wants these, because at their level of risk, there's always a possibility of a higher return if you have a different combination of bonds and stocks. So we can create a system where we generate a return risk portfolio for combinations of stocks and bonds. And that allows us to create what we call the efficient set. And the efficient set is within that red circle. Those all have priority over ones that fall to the left of the red circle or ones that fall below the red circle. The reason we have different combinations is because there's different correlations between the assets that we put in our portfolios. And so if we have stocks and bonds that are perfectly positively correlated, so they have a +1 correlation, that means when the stock moves up, the bond moves up by exactly the same amount. There's no diversifying benefit of that. On the other hand, if we have a portfolio whose correlation is a -1, that means when one goes up, the other goes down. So that's perfect diversification value. You're going to have a lower overall return, but you'll have no risk. The one offsets the other. what we typically see is we create portfolios that have correlation coefficients somewhere in between this red line, this red semicircle. That's what's most common when we look at the correlation between assets and bonds that we can put into a particular portfolio. So ordinarily what we're looking for is to create a portfolio that has diversification benefits that's less than 1, and getting somewhere close to 0 is usually about as good as we can do. Okay. Now, when we look at different classifications of assets, we see they all have different risk and returns. And what we can do is we can create a graph of all of the different possibilities of stocks and figure out which ones we prefer. And if you look at this, when we talk about stocks that fall here, nobody would prefer that when there's a portfolio up here that has the exact same risk, it has the same standard deviation, but it's earning a higher return. So rational investors would prefer stocks up here. And that's true. Oh, why do I have red going here? Let me just change my color real quickly so you can see it better. That's true of all stocks. Oops, that didn't work well. Great. Sorry, it's giving me a hard time here. There we go. That's true of all stocks. Oh, well, it's going to be a long afternoon if it won't let me draw anymore. All stocks that fall, yeah, won't let me move. Okay, from, let's see if it'll let me put a text box. Houston, we have a problem. Yep, my drawing tool just died. Okay, when I take a break, I'll shut down and see if I can fix it. Every stock from the, let me show you on the next graph. It'll be easier to just show you rather than trying to make it, trying to explain it. Okay, good. So good, now it must have just been that slide. So from this blue dot forward, this is the set of stock combinations that's the most efficient. This is the minimum variance portfolio. This is the lowest risk portfolio, and everything up above is better than everything below. There's no stocks that can be up here. That's not a possibility. All of the stocks are going to fall somewhere with the correlation. With this particular correlation, they're going to fall somewhere in here. They could be all over here, but nothing will be above this particular, given our correlation between our assets, nothing will be above this red circle, this red semicircle. And what we find is that the ideal stocks are the ones, the ideal investments are those that fall between that minimum variance portfolio and up to the top. And what we would prefer, we would all prefer to be on this front, on this what we call the efficient frontier. Where we would be along this efficient frontier depends on our risk preference. Some of us would prefer to have very little risk, and we would pick the minimum variance portfolio. Others are willing to take on more risk for a higher return, and you would be located further up the efficient frontier. So what we now know is that when we look at our stocks have an expected return and they have an unexpected portion. And we know that. We know that if we look at the stock, if we look at Tesla, we have an expected return for Tesla based on its performance. When Elon Musk does something stupid like an April Fool's joke, that's unexpected news, and the market reacts to that unexpected factor, and the stock price drops. When somebody is killed with an autonomous vehicle, that's unexpected, and the stock is going to react. So when news is announced, there's some portion of it that's expected and some portion that's unexpected. What is priced in there is the expected. What we expect to happen is why the stock market is priced where it is. If we look at Amazon next quarter, when it makes its quarterly announcements, we have an expectation on what the price of Amazon is going to be. When they exceed those expectations, that's the surprise that causes the market to move. If they just hit expectations, the stock really won't react much because it's already been factored in there. What we know is that diversification helps to reduce our variability. One stock, unless the correlations are a positive one, they're perfectly positively correlated, having different stocks and bonds in a portfolio will help us reduce our overall risk. But we can't reduce all of our risk. There is some level of risk that everyone is exposed to. Everyone is exposed to the fact that the Fed raises interest rates. Most stocks are going to react negatively to that. Some won't, but there are some risks that you just cannot avoid. There might be a trade war with China. The market's down. That's risk that can't be diversified away. But the risk that Elon Musk says something stupid that causes Tesla stock to go down, that can be diversified away depending on what else you put into your portfolio to offset it. When we look at our portfolios, we pay for the fact that some risk can't be diversified. There's a standard deviation for a portfolio based on the fact that there is a minimum amount of risk that all stocks are exposed to. They're not all exposed in exactly the same way, but if interest rates move, all stocks are going to react in some way. If there's another 9/11, all stocks are going to be impacted some way, some more than others, but everybody's going to be impacted. But things like when Elon Musk says something dumb, that affects Tesla. General Electric might not move at all for that. That risk can be diversified away if you add enough other stocks into your portfolio. Bad news for Tesla may have been good news for GM. And so if you own both in your portfolio, it could be that when Tesla has a negative effect, GM is positive. So you can diversify away the fact that Elon Musk occasionally says stupid things. But another war, trade war, interest rate movements, you can't diversify that away. Everybody is subject to that, and that's what's priced into our stocks. That's why there's risk attached to stocks, because you can't get rid of all risk. That's been a long time. Let's go ahead and take a break, and then we'll come back and we'll finish up with this last section, and then we'll move into chapter 13. So go ahead and come on back at 10 after 12, and then we'll keep going on the chapter. Any questions before we pause? Sorry about that. So when we talk about risk, we have two kinds. We have systematic risk that affects everybody. You cannot, no matter how many assets you add to your portfolio, you really can't get rid of that risk. It's the broad macroeconomic factors that affect everybody. And then unsystematic risks are specific to particular companies or industry that if you do a good job of diversifying, you can get rid of most of that. And as a result, because you can diversify them away, people aren't going to pay you for that unsystematic risk. So you're not going to get paid. There's a trade-off between risk and return. The more risk, the higher the return. But they're not going to pay you for the risk, the unsystematic portion of the risk. They're not going to pay you for the fact that Elon Musk says stupid things, and so the stock becomes a bit more volatile based on dumb things that he says. You can diversify that away by also owning GM that benefits when Elon Musk causes Tesla's value to decline. So systematic risk are those big macroeconomic variables, changes in GNP, changes in employment, interest rate, inflation, but they're also the big events like a 9/11, like the Great Recession that affects everybody to different extents. Okay, so announcement effects, unsystematic risk is diversified away. And so what the standard deviation measures is your total risk. And really what we're concerned with is the portion that can't be diversified. The reality is the unsystematic portion is very small when you think about it. When you think about what causes Amazon's price to move, it is economic factors. It is inflation. It is interest rate movements. It's their earnings announcements, the expected portion of their earnings announcements. The unexpected portion is really very small. So when we look at the risk of our portfolio, again, we go back to looking at from the minimum variance portion of the portfolio all the way up to the top on that red line. But what if we now look at adding a risk-free asset? And if you think about it, if you're going to invest money, you're going to choose some stocks you want to buy. You're going to choose some mix of stocks and bonds. And you may say 0% bonds. That's still a choice. You're choosing all stocks and 0% bonds. That's a mix of stocks and bonds. But you also have some amount of money that you don't put in the market that you keep in cash or in the bank, essentially at a risk-free rate. What we're introducing as our risk-free rate here is a T-bill. And so when we look at it, we have a combination of money that we don't invest in the market and then stocks and bonds. And we can create an optimal portfolio of mixing of cash, stocks, and bonds. And what that looks like is this capital market line. And there is an optimal portfolio. It's where your combination of risk-free stocks and bonds has the highest return given the level of risk. And we call that the optimal portfolio. If everybody had the exact same beliefs, everybody would own that portfolio. Everybody doesn't have the same beliefs. We saw that a little bit ago when we saw that Dan and Christian Dan and Connor had very different ideas about which stocks whether or not they would own Amazon. People don't have the same risk preferences. But what we find is that people will fall somewhere, given the theory, people will fall somewhere along this line of combinations of risk-free assets, bonds, and stocks. And let's say you don't want as much risk in your portfolio. You may choose to be down here. You may choose to lend money or put more money in the bank and own less in the way of stocks and bonds. And that's perfectly fine. It's still efficient. It's not as high as a return as you earn over here, but it's efficient in terms of the risk and return trade-off that you're actually earning. So where you are along this capital market line will vary depending on what your preferences are about risk. Okay. All right. Now, when we're looking at any particular asset and we're looking at its riskiness, the way we measure that is with beta. We talked about this earlier. And beta is a covariance measure. It looks at how our asset moves relative to the market in general. And when we look at beta, high beta stocks are stocks that are riskier. So anything above 1 is considered a high beta stock, and anything below 1 is less risky. What we do is we plot returns on stocks relative to the market, and we can draw a line through it and determine, and the slope of that line is the beta for the stock. That's what we're doing when we're calculating the beta for your portfolio. We're looking at the returns for your portfolio relative to a particular stock within your portfolio to see how risky your portfolio is relative to the market. And what we know is that if you own stocks in the market, they're going to earn a return because you're not going to own them if you're not going to make money on it, and they're risky, so you have to make money on them. So the return on the market is equal to some general time value of money plus a market premium. What's this time value of money? If I put money in the market, I don't have the use of that market for some period, I don't have the use of that money for some period of time. And so I expect to be compensated based on the fact that I don't have the use of that money. So there's a time value factor. That's particularly important if you're in Venezuela with 1,300% inflation rate. Putting money into the market is very risky there because it's going to be worth a whole lot less when you get it back. So for any investment that you have, there's some portion of your return that's just sort of a convenience factor, inconvenience. You don't have the use of your money while it's invested. You don't have the ability to spend something else. You're giving up the opportunity to use that money for something else. So all assets have some risk-free rate, which is kind of the inconvenience factor. And then it has some premium above that based on how risky the asset is relative to risk-free. And so the stock market, the S&P or NASDAQ, has a premium above a risk-free rate. So for any security that we expect to hold, the return we expect for that security is equal to a risk-free rate, which is the inconvenience of not being able to invest right now. It's a market premium. The fact that I'm investing in the stock market is risky. And then that's modified by the fact that my particular stock has a level of risk. And so this is called the capital asset pricing model. And what this model tells you is how much you can expect to earn if you hold a particular share of stock. And again, that's called the market premium. So the model, CAPM, tells us that if we look at a share of Amazon, all stocks have a risk-free rate. All stocks have incorporated in its return a risk-free rate. All of them are invested in the market. The market is risky in general. And then all of them have some level of risk that is above or below the market level. And we can figure out what we would expect to earn if we held a share of Amazon or Tesla based on this particular formula. Okay, so anytime the beta is equal to 1, the stock is as risky as the market. The beta is 0, means it's basically a risk-free rate. There really are not 0 beta stocks. But we can see betas going up to 1.6, 1.7 sometimes for very risky stocks. Higher the risk, the higher the expected return. And the way we incorporate this formula is, that's the market, that's the basic market portfolio. This is what I was going to show you. So if I know I have a company whose stock is has a beta of 1.5, and I know the risk-free rate is a 3%, and the market return is 10%, and I'm going to show you where we come up with those numbers, then if I hold this stock, on average through time, I should expect to make about 13.5%. That doesn't mean I'm going to make 13.5% this year. In any one year, the stock's going to move all over the place. So it could be this year, the stock is up here, and next year it's down here, and I mean it's gonna move all over the place on a year-to-year basis. But if I held this stock and market conditions don't change and the risk-free rate doesn't change, then in general over time I would expect to earn about 13.5% on this particular stock. If I had another stock whose beta was 1, in general I would expect to make about 10%. Why? Because if the beta is 1, I have 3% plus 1 times 10% minus 3%, and that equals 7, and that equals 10%. Okay, so what my anticipated return is will vary depending on the beta of the particular stock. Put that in, so I don't remember where's that anyway. Okay, now this is important because it ties into a whole lot of how companies go about calculating their required return and how they evaluate projects. When we do our weighted average cost of capital analysis, this becomes critical. And I wanted to talk a little bit about that now. How many of you have questions about CAPM here and how we develop CAPM? This whole chapter 11 is just about the theory and coming up with this capital asset pricing model. And I'll show you now why this is important. I'm going to stop sharing that. I'm going to put up something different. What I wanted to talk to you about is your weighted average cost of capital project. Let's see, where did I put that? Okay. Now we're not starting the project this week, but you now have all of the pieces. And so I want to walk through what I want you to do for this project. And okay, first, before next time, on our website, there's 2 articles that you need to read. So on Moodle, there's the Bruner Best Practices in Estimating Cost of Capital, and there's the Fama-French 3-factor model. So what I want you to do is read chapter 13, and then I want you to read these 2 articles. We're going to spend a lot more time on this next time, but I want you to read those 2 articles. And the Bruner article talks about CAPM and how companies are using CAPM. The reality is CAPM is as you'll see in these models, in these articles, CAPM is a good theoretical model and companies use it, but it only explains about 30% of the variation in how stocks actually move. So Fama French was an attempt to improve upon that method, and it's better, but it's not great either. So those two articles become critical for a weighted average cost of capital analysis. If you haven't read these when we talk about it next week, you're going to have trouble with your assignment. Okay, now this part of the assignment I want you to ignore right here. Ignore this part, because this part says go talk to somebody at your company. What I found when I've done this with Mac students in the past is you don't have enough clout to go talk to the right people at your firms. If you're interning there, 2 years from now you'd be able to do that without a problem. But skip that part. Instead, what I want you to do is this. I want you to pick a company, and you're going to calculate a weighted average cost of capital in the company based on publicly available information. And for this assignment, you're not writing me a paper. You're going to create a PowerPoint, and you're going to do a VoiceThread presentation. It's why I have you do VoiceThreads at the beginning, so that you get better at it. It's why some of you are advantaged because you have done an online presentation. It helps get better at it. And at the end of this assignment, I include how I grade this so that there's not any confusion on what I'm looking at. Presentation matters, and your ability to present in a way that people would want to listen to you is an important thing. So at the end of this assignment, which is posted on Moodle, is the rubric on how I grade, and you'll see delivery matters, the quality of your slides matter, your ability to do the models matters too, of course. But what I want you to think about is I want you to think about graphics on your slide. I want you to think about not more than 15 words on your slide. I want you to present in a way that somebody wants to listen to you, so be engaging. And so in the next couple of days, please read chapter 13. Read this assignment and tell me what company you want to work on. Next time I'm going to go through and I'm going to show you how to get the data on Bloomberg, how to get it on Capital IQ, how to go to our wiki and look at samples from other students and how they went about gathering this data. I think that you'll find that that's all really helpful. But as soon as you know what company you want to work on, send me a note. Here's the deal. They have to be publicly traded. They have to have traded for at least 5 years. And they shouldn't be in a highly regulated industry. So you don't want banking or real estate, utilities. You don't want any of those highly regulated companies because they become a little bit more difficult. All right, but CAPM becomes critical for this particular assignment, okay? So before next time what we're going to do, we're still going to do a little bit of chapter 13, but for next time, we're going to do our review of the week, then we'll go ahead and do our simulation with Euroland, and then we will jump into chapter 13 and we'll talk a little bit about this. I'll make sure next time I take the time to show you Bloomberg and Capital IQ, how to get the data that you need from those two sources so that you're able to start working on this project. And hopefully we'll get to the articles. But the assignment's not going to make a whole lot of sense if you don't read those articles, because the two methodologies are described in those two articles. Any questions on where we are on the weighted average cost of capital assignment? You're doing this part where you select a publicly traded company. Okay. Okay. All right. Short of questions, we're going to start on chapter 13, and what you'll find is you're going to like chapter 13 because there's absolutely nothing new in it. It's all a repeat of things that we did in previous chapters. Emily, are you able to see chapter 13 now?
Yeah, I can see it.
Okay, good. I wasn't sure. It came up in a funny way on my screen, so I just wanted to make sure. So chapter 13 is all repeat stuff. And we're going to show how these chapters 10 and 11 all fit together into one big model, why we had to learn how to do cost of debt and cost of equity. And so we're going to start with our cost of equity. And if you remember, we talked about dividends and we talked about the dividend discount model. One way you can calculate the return on equity is using the dividend discount model, which is your dividend a year from now divided by your price plus the growth rate. This is a nice model for coming up with the cost of equity. It's theoretically sound and it works, except it doesn't work most of the time. The problem is it requires that companies pay a dividend and that dividend grows at a constant rate. Those conditions nowadays just don't really exist. So for most of you, if you do a dividend discount model, you do it as sort of a tertiary measure. So you run a FAMA French, you run a CAPM, and you do this as a third method just to prove your results. But it's not a primary method anymore because it just doesn't work very often. So ordinarily, you can run a dividend discount model, but you don't rely on it very heavily because of the violations of the requirements of dividend discount model. Typically, if you're trying to find the cost of equity for a company, you use CAPM. And so you look at the return you expect on owning a share of stock is equal to the risk-free rate, which is some rate we've got to come up with. We'll talk about that a little bit more next time after you read the articles. The market premium, the fact that the market in general is riskier than a risk-free rate, and then the beta, which is how risky your stock is relative to the market. You have to come up with a risk-free rate, and we used to say that was a T-bill rate. Most companies now use a T-bond rate, and we'll spend a little bit more time on that. When you talk about the market, you could talk about the return on NASDAQ or Nikkei or any other market, but typically what we use is the S&P 500 is the most common measure of the market. It's a broad-based index, and so it typically is the most representative of market returns. So if we had a company that that makes PowerPoint presentations, it has a beta of 1.5%, it's all equity financed, it has a risk-free rate of 3% and a market premium of 7%, what would you expect the return to be on that particular stock? Take a minute and see what you think, and raise your hand when you have an answer. Dean, what do you think? What would you expect that return to be?
I'm still. Oh wait.
So working.
Is my video working now? Yeah.
Are you on?
I'm still working on the calculations.
Okay. Leah, have you gotten it yet?
9%. I don't know.
Close.
What did you say?
Your mic's on. Leah, what did you get? Mic's not on.
Sorry, I couldn't hear you. I didn't get it yet.
Got it. Okay. Anybody? Dean?
I'm taking a guess here. 6%.
Nope. Anybody else?
Is it 9%, like Jess said?
Nope.
Okay, my second guess is 13.5.
There you go. 13.5 is a good guess. Okay, so for this particular problem, what it's asking you for, CAPM is not hard to calculate. It's just knowing what the words mean. So the market risk premium is all of this. If I told you the return on the market was 6% and the risk-free rate is 3%, the market risk premium would be 3%. So the market premium is the entire section that's in parentheses. This is just the return on the market. So we could say the S&P 500 has a 12% rate of return. If our risk-free rate is 3%, then our market premium is 9%, 12% minus 3%. So what we did is we had a 3% risk-free rate plus a beta of 1.5 times a market premium 7%. So for this particular stock, I would expect to earn 13.5% over time. Now the risk-free rate. Okay, so it used to be, we said T-bills were the risk-free rate. But what we use CAPM for most frequently is to figure out whether or not we would invest in a particular project over time and what the cost of equity would be for that project through time. And what we've discovered over time is that we can't just rely on a T-bill rate, which is a 90-day rate, because most projects are invested for 10 plus years. So most companies use a 10-year Treasury bond rate as opposed to a T-bill rate. If you all worked for different companies right now, I would have you go and talk to the companies and see how they came up with their cost of capitals. And what we would find is lots of different options, but most companies have moved away from T-bills to move to a T-bond rate. When you read that Bruner article, it was written a number of years ago, and a lot of companies are using T-bill rates at the time that that article was written. Now, they talk in this book about what in general your market return should be. The problem is the market returns in the last 10 years have not been at all consistent with what they were historically, and part of that is all of the systems trading that goes on now. That the technological trading has caused the returns to shrink a bit, and so when we talk about returns, we used to go back to looking at data in 1923 and looking forward. We don't really do that anymore because the markets are so different now. So this particular slide concerns me a little bit, saying, yeah, it's about a 1 or 2% premium over the T-bill rates. That really isn't true anymore. And what we'll learn next time is how to calculate those rates so that you can calculate it yourself and make some decisions. Now, as I said, the market portfolio, that return on the market, is typically represented by S&P 500. That's the most common. And then beta looks at your stock relative to the market. The problem is, if Rachel did this, she might calculate beta looking at daily returns over the last 2 years. And Dan might calculate this using monthly returns over the last 6 years. And so beta is going to be very different depending on how you calculate it. I'm going to show you how to get these calculations already done for you out of Bloomberg. And what you'll find is that Bloomberg doesn't tell you exactly how they calculate it. And if you pull them out of Capital IQ or you pull them off of Yahoo Finance, you're going to get very different answers because they calculate them very differently. And that Fama French article starts to get at how those calculations are made. I think this is going to be important. I know a lot of you are going to be auditors, and what you'll find is as you go into audit companies and you look at how they're analyzing projects, how they're calculating their returns will be relevant to you at some point in the future. So what determines your beta for a particular company? It's determined by what your revenues look like. Companies that are heavily dependent on fourth quarter revenues often have higher betas because they're so focused on, so much of their revenues are coming from just one period of time. We saw this fourth quarter of 2017 for some in the retail industry was a great year. For many others it was not. And if that's 75% of your returns are occurring that last quarter, that's a problem. If you have a lot of fixed assets, and so you have to earn a high enough return to cover all of the interest on your debt. The operating leverage, companies with high operating leverage typically have more business risk, and then companies with a lot of debt typically have a lot of risk as well. They have financial risk. So high fixed asset businesses, high debt businesses with a lot of cyclicality to their revenues, they tend to have higher betas. So this book only talks about using dividend discount model or CAPM to calculate your cost of equity. In reality, there's also the Fama French model, which is in the article, which we'll read separately. Then we get to cost of debt, and the cost of debt we did in a couple of chapters ago. The way we calculate the cost of debt is we look at the yield. There's interest payments over time every 6 months over the life of the debt, plus getting the $1,000, the principal, back at the end of the life. The only thing with calculating cost of debt, you do those calculations, and then you remember that debt's tax deductible, and so you subtract out you calculate the after-tax cost of debt. And then some companies have preferred stock, not many, and preferred stock typically doesn't represent more than 10% of the funding for the company. But if they do have preferred stock, it's a perpetuity, and it's essentially the same as the dividend discount model. Their return on preferred stock is equal to the dividend divided by the price that you pay. You throw that all together and you come up with a cost of capital. So you look at the percentage of equity financing you use times the cost of equity, plus the percentage of debt financing you use times the cost of debt, times 1 minus the tax rate because it's an after-tax. And if they use preferred stock, you look at the cost of preferred divided by the percentage of preferred that they actually use to come up with a weighted average cost of capital formula. It's really easy. It is not a tough calculation. And I can't believe this slide doesn't have them in there. I want you to do a couple of problems just to practice a little bit, and I'm going to have to find them. Let's see. All right, let me go a little bit further because I pulled up chapter 13. I didn't pull up the ones. Let's look at something. I wanted some that had solutions incorporated, and this one doesn't. Look at this so fast. Here we go. Okay. Wait, let me do one more thing, and I think I'm going to get there. All right, take a minute and take a look at problem 1 at the end. Oh, you know what? Let me do one example first so I can get you there. Okay. So when we look at figuring out the value of the firm is really just a sum of all of its projects that it has going, valued at today's dollar, and we discount them back to today's dollars. So let's do an example of a company, International Paper, and we're going to calculate their cost of equity and cost of debt and their beta and come up with the weighted average cost of capital. That is the discount rate that we've been using in our projects up till now. So if we have a company and the beta is 0.82, the risk-free rate is 2%, and the market premium is 7%, all right, take a minute and tell me what the cost of equity will be for this company. Let me know when you have an answer. Raise your hand if you come up with an answer. Sean, what do you got?
I'm having some trouble with this one. I didn't get anything.
Okay. Ethan, do you have an answer yet?
I got 7.74%.
How'd you do that, Ethan?
I did, what did I do? I did the risk-free rate plus the beta times 0.07.
That's pretty good. Okay, so that's all there is to calculating cost of equity. It seems, good job, Ethan. It seems really simple. The hard part about CAPM is figuring out what risk-free you want to use, how you're going to calculate your beta, and what period of time you're looking at the return on the market. If we looked at the return on the market from the first 8 months of the Trump presidency versus year to date today to the Trump presidency, we have a very different return on the market. So you have to make some value decisions on what you're using, what time frame you're using. And then if we know the company's debt is 5% and has a marginal tax rate, and that we know that we're using 32% debt, if we're using 32% debt, Bridget, how much equity financing are we using if they have no preferred stock?
I'm not sure.
Okay. Anybody else? How much debt are they? If they're using 32% debt, how much equity financing are they using? Brian?
Would it just be 68%?
Yeah. If we're using 32% debt, the rest is equity finance if we don't have any preferred, so we're using 68% equity. So we calculated a cost of equity at 7.74%. Debt's 5% with a tax rate of 35%. 32% debt financing, 68% equity financing. The calculation's not challenging. 68% is the percentage of equity times our cost of equity plus 32% debt financing times our cost of debt times 1 minus the tax rate means that when we calculate for this company, if they're undertaking a project that's as risky as the company, we would use our required return would be 6.3%. That's where that number comes from. And nothing about the calculations are hard. The only challenge with the cost of capital is figuring out what inputs you're going to use to come up with a number. Now let's take a minute and do a couple of problems just to try to cement this in your mind a little bit. Take a look at problem 1 at the end of chapter 13. And I'll go ahead and put you in rooms. Tell me who's in the classroom so I can make sure to put you guys in the same section. Christian, who else is in there with you?
Sean, Dean, Connor, myself, and Brooks.
Okay, hold on. Christian.
And Leah.
And Leah. Did you tell me? Okay, so I've got Christian and Connor and Leah and who else? Angie?
Angie.
And Sean and Dean.
Oh, Sean. And who else?
Sean.
Dean.
And Dean. Dean. Okay. All right, so I put you guys all in one room. And, okay, so we do breakout room 2. Okay, and breakout 3. Okay, so take a couple minutes and work on this problem and then come on back. Okay, let's see, who have I talked to in a while? Dana, what did you get for the cost of equity?
My group got 12.22.
Okay, did you agree with them?
Yes.
Okay, good. Yeah, the only thing confusing about this one is they gave you the market return instead of the market premium. That's just to remind you to the difference between RM and RM minus RF. So they tell you the premium, it's the entire thing in the brackets if they just tell you the market return. Anybody have any questions on how we did that calculation? It's really straightforward. The only challenge is to find these values that you're plugging in there. That's true of most of finance. The challenge is coming up with the numbers and telling a story that justifies them. Okay, I'm going to pop you back into rooms again, and let's do problem 2. Sorry, Christian, I didn't intend to bring you back. I hit the wrong button. Were you guys done? Christian, Connor, were you done?
Yeah, we think we are.
Oh, okay, cool. That was fast. I wasn't expecting you to be finished that quickly.
Yeah.
Okay, well, they've got about another 20 seconds to be back. Okay, let's see. Okay, Dan L., how'd you do on this one? Dan, your mic's not on.
Sorry, yeah. For pre-tax, I think we got 9%.
Not quite right. Let's see. Chris D., what'd you get?
For pre-tax, we got 9.16%.
Did anybody get anything other than 9%?
We got 10.77. On it though.
Okay. Let's see. Who's in a different room? Chaz, what'd you get? Turn your mic on.
We were still trying to figure out how to like go about it, because one thing when I was looking at it, because it's quoted at 95%. So are you assuming that you're taking like like the 1,000 times that 95, so you have the 950?
Exactly right. Yeah. So your present value is 950. Yeah.
And then you have coupon payment being, it's based off, would be what, 7%? So would you, in semi-annually, so would you divide that by 2? So you have 3.5. So it's going to be $35.
Beautiful.
So would you take the 950 divided by the $35?
No, nope. You got to do a full yield to maturity problem. Yen.
Okay.
Yen, what you've got most of it there. Yen, what did you do? Turn your mic on, Yen.
I have no idea.
Oh, so. Yeah, okay. Still working on it. Okay. Emily, what about you?
We don't know. We didn't really come up with an answer in my group.
Okay. Let's remind you how to do these problems. So we have 13 years to maturity and it's semi-annual. So N is 26. As Chaz noted, the present value is 950 and this should be a negative 950 if you're putting it in your calculator. Your future value is always 1,000. And the payment is 7% or $70 per year or $35 per period. So when we compute the interest rate, it should be 3.806. That's per period, and you double it to get to the 7.6. And what they've asked you for is the after-tax cost of debt. So then you multiply that by your 1 minus 35%, and you come up with an after-tax cost of debt of just under 5%. And almost always when you're asked for a cost of debt, they're asking you for the after-tax cost of debt. Okay, any of that confusing? You want me to run through it again? You're all feeling pretty confident there?
Yeah, I think the thing that I didn't like, that I'm mistaken that I didn't do was use my calculator, because I wasn't assuming that this is kind of like a calculator thing. So yeah. I had like all the numbers there. I just didn't know that had to be put inside the calculator, because if that was the case, then I would have got it.
Yeah, if you had all the numbers, Chaz, if you had done the calculation with calculator or Excel, you would have arrived at the right answer. Because of the time value, because those calculations are spread, those interest payments are spread out through time, you have to figure out what they're worth today. So you can't. You did a shortcut that got you close, but it's not completely accurate. And because of the impact of our cost of capital on project valuation, we try to make it as accurate as we can, even though there's a ton of assumptions in there. Okay. Everybody okay with number 2? Remembering how to do that? That's why chapter 13 sums up so many different chapters. We'll see it. I'm going to have us do Yeah, let's do one more problem and then we'll wrap up. Take a look at problem 5. And I promise not to pull you out of your room so quickly. I didn't intend to do that. That was an accident. I hit the wrong button. So let's take a look at problem 5 in your rooms and then come on back and we'll work through that one. Dana, are you feeling confident? You're muted. All right. Rachel, how'd you do?
We got 9.2%.
Anybody get anything different? Dean, what'd you guys get?
I got 9.29.
Okay. Okay, so this was nice. In fact, they did the calculations for us, so we're just throwing it all into the formula. Cost of equity, they told us, is 11.5%, and we are using our cost of debt's 5.9. It is not an after-tax cost of debt, so we need to subtract that out. Hey, Dean, turn off your mic, please. The tax rate's 35%. Thanks. Oh, still somebody's on. Thank you. Equity is 70%, which means there are 30% debt finance since we don't have any preferred shares. That's the standard formula. And we throw it all in there, and we come up with 9.2%. So when we come back next time, what we'll do is, yeah, we're going to do problem 21, and it's a whopper. So number 21 has us throw everything from chapter 6 as well as chapter 13 together. That one's going to take us a little bit of time. Any questions on the basics of how you do a weighted average cost of capital? It really is just pulling together what we did in chapters 8 and 9, and then a little bit of chapter 11, and putting it all into a formula. So just recalling how to do those cost of debt calculations and the cost of equity, typically with CAPM, and then just put it together. Okay, so let's talk about what's next time. So next time we'll do our review of the week. We're in person. We'll do our review of the week. Then we'll move into doing our Euroland simulation. You have to be here. If something comes up this week and you're not going to be in class, I have a way that we can morph you in. It's not as good, but missing class next week could have bad ramifications for your final. So if something bizarre comes up this week, please let me know right away so that we can figure out how to make this work. So come to class ready for your roll. So we'll be in your roll. Then we're going to finish up chapter 13. I'll demonstrate how to do Bloomberg and S&P Capital IQ, so you can start working on your project. And we'll debrief on Euroland, and then we'll discuss those 2 articles that are posted on Moodle, the Bruner article and the 3-factor model. I think that should be a good bit of work. That'll keep us occupied a good bit of time. Any questions before we wrap up for today?
Professor, what time did you say our papers are due for Euroland next week?
I'm going to have to send you an email. I can't remember. Does anybody remember?
I don't think you mentioned it before.
Oh, really? Okay. I'll look. At the latest, it'll be 9 a.m., so I have a chance to look at them before class. Sometimes I make it well, let's just make it 9 a.m. So class is at 11. Make them due by 9 a.m., and I have a chance to zip through them quickly before we go to class, so I'll have a sense for what you were thinking as your role.
Do you want to print out as well, or just online?
Oh, I don't need it printed. No, just send me. I much prefer it if you just send it to me online, and I grade it online and send it back to you. Okay? Thanks for asking. Anything else? All right, guys, have a great week. I'll see you in person next Wednesday. Bye, guys.